Welcome all to the Node. I am Mike, aka Veteran Crypto, and I'm sure David will be joining us as usual here in a few moments. But until he does, let's go ahead and jump into our socials. So, if you want to join us, join the chat, join the conversation, you can find us on YouTube at the Node Network, all one word. And you can see we are truly are a network. So, just today, we have actually 4 shows. So, 3 live shows and 1 pre record. So, as of right now, you're watching the Node main show. Immediately after this show is the blockchain report with Jeff, where he's going to be doing a deep dive into a new AI project and potentially looking at airdrop farming. I haven't watched the episode yet, but I know that that's many of the projects that he looks at are airdrop worthy. So after that, you have at 1 p.m. Pacific, 4 p.m. Eastern, you have David doing his daily market wrap. And tonight, you have Jay and Ellie's Gaming and Chill at 6 p.m. Pacific, 9 p.m. Eastern. And they will probably be playing Arc Raiders. I'll most likely be joining them, possibly David, but probably be playing Arc Raiders. I know that we're looking at a couple of other games that are a little more relaxed, a little more chill, just to mix it up a little bit. So she's busy right now looking up some games. So, but some of the other shows that we have here are Crypto and Chill. That's a show with me and Jeff on Tuesdays and Fridays at 5 p.m. Pacific, where we just relax and just talk about life, talk about what's going on in the markets since the last episode. Just kind of wrap things up. I already talked about the blockchain report with Jeff. We have Sovereign Soil. So I started doing this on my own. Drew drops in from time to time, and also Jay. So Jay from our chat and from our community. Hey, what's up, Deadwood? Jay from our chat and our community and Gaming and Chill. He has started to join me and going to join me last Saturday. Is going to be joining me this Saturday, and we're going to be going over our preps and kind of what we've done to as far as emergency prep, and maybe refine them a little bit. So Jay is geared more towards bugging out, whereas I'm bugging in. I'm surviving in place. I'm already at the optimal place that you would bug out anyway. So I'm just setting up shop to sustain myself long term. Whereas Jay is geared more towards being in a more urban environment, I do believe, and he's wanting to gear up so that he can get to a place to where he can survive long term. So we're going to cover that this Saturday, and of course with the market wrap that David does daily, Monday through Friday. On Tuesdays and Thursdays, he includes Ellie, who is a member of our community that is from Gaming and Chill. And he is putting her through the one-on-one coaching course that he offers on our website, thenode.pro. And so if you want to get a look at what that's all about and you want to schedule your no-cost initial consultation with David, you can find how to do that, and I'll go over it here in a second on thenode.pro. Saturday, Jeff is a DJ in the Bay Area in San Francisco and has a bunch of friends who are also DJs. So he does interviews, tutorials, and sometimes just spins music, and has been talking about doing all original music. So using AI for his samples so that it doesn't get dinged by the AI here on YouTube and get demonetized all the time. So he wants to possibly start doing fully custom music, that are 100% him. The Red Pill, Thursday at 6 p.m. That's where we get together and talk about controversial topics, politics, religion, relationships. The last one was about the legalization of some psychoactive substances for PTSD and different things that Trump just legalized. With the prodding of Joe Rogan, and also the movement of marijuana from a Schedule 3 to a Schedule 1, which basically takes it out of the same category as like heroin and puts it in the same category as Tylenol with codeine, where honestly it shouldn't even be that. But I digress. And then gaming and chill Wednesdays and Sundays is it's a great way to place to hang out. We just laugh and joke and mess around. Great place. So that's what we got going on there. If you want to join us on X, then you can find us at the node_network. And if you want to find our main website, it is thenode.pro. So you can come here, and this is where this is the node of the node. This is where it all comes together. You can find all of our programming, our schedule. This shows all of our different live shows in gold. The purple is David's daily calls that he does with the community. That is a paid service. It's $99 a month, but a great resource if you are wanting to take your investing to the next level, both TradFi and DeFi and crypto. So they talk about different strategies that they're using to earn yield. You can find mentors, people that are at different stages in their journey and different levels of success. You can find somebody that aligns with kind of what it is that you're trying to accomplish. So great place. And then also in red are our evening shows. So this is a great resource if you're just wanting to see what's out there. You also have the courses. So DeFi University is a no-cost educational program that David has put together that we offer to the community. Again, there's no gimmicks, there's no charges. Just start first lesson. You can start there on our homepage. If you want to find your starting point, it'll ask you like 2 or 3 quick questions and put you where you need to be, depending on where you're at in your journey. But a lot of great courses in here, and we focus heavily on investor mindset here. We don't just throw you in and have you start, putting liquidity in the markets. We make sure that you're ready to make the right steps and that you have the discipline and the proper mindset so that you don't get taken advantage of in these markets. If you want to join the community, you can come to the community tab and join the school. You can also join our no charge Discord. Again, great community of people where you can ask questions, and we're more than happy to help people no matter where you're at in your journey. If you're a scammer, don't even bother. This morning, somebody tried to drop in and start spamming, all of our different channels. Ellie booted them out and deleted all their posts. So we have a bunch of really great mods that are in there. One of us is always in there. So if you're a scammer, don't even bother. You initially enter as a pledge. So there's a bunch of stuff that you can't do anyway. And so yeah, you're just gonna get booted. So save yourself the time. Coaching. This is what I was talking about. If you want to book your no charge discovery call, just go ahead and put your email in here, and David will reach out to you. They ask a couple of quick questions just to get an idea of where you're at, and he'll let you know. Honestly, if the coaching program is right for you, or maybe you're not ready for it. Maybe you have some education to do and some mindset work to do, and he'll steer you in the direction of the no charge education. And then once you're done with that, then come back and maybe start your coaching. It's something that you two can hash out. And then this I'm very excited about. David sent me this morning, and he got the newsletter working, which was really, really cool. So I'll put my email here.
So, Mike, this is version 2.5, the version that's going to be shipping in, I don't know, it looks like maybe about 30 minutes during the call today is version 3.0. So, yeah, it's going to look even better than this in just a couple of minutes.
No, that's awesome. But you can get a sample right now. So if you want to put your email in there, and you can see it's generating it based off the assets that I selected.
So actually the sample is kind of messed up right now. I'm pretty sure it just selects like a handful of default assets.
It does. Well, yeah. I mean, you can select. It will select Bitcoin and ETH, and you can select one more, but it's very limited. and it's because it's a free sample. You know, it's so that you can see, you know, the data and the layout and stuff like that. The paid version, which is 66 cents a day, $20 a month, you can choose whatever assets you want. You can choose crypto, stocks, commodities, whatever. You can see by default, it gives you Apple, the S&P 500, the NASDAQ, and the Dixie. But you can select your portfolio, and it will tailor make this for your portfolio. It will give you your, you know, like, you know, sources. It will give you, you know, the different assets, the price. You can look at the ranges. So it will give you the support and resistance. So if you're looking to get into a liquidity pool or you're looking to do some trading, you can do, you know, the on-chain data on the different assets that you choose with links so that you can verify the information, because you should always verify information. The flows, it's going to give you the you know, inflows and outflows for the ETFs. The derivatives, a bunch of data on derivatives, the big story. So basically, what's going on in the markets with, again, links, so that you can read in depth if you like, and, you know, verify. You should always, always, always verify the data. Your quick hits. This is, again, you know, headlines, you know, for different news articles with links so that you can read more in depth. And then our take, you know, the nodes take. So it gives you the, you know, the broad, you know, overview, and it gives you in the next 12 hours what we see, the next 24 hours, and the next 72 hours. So this is a very comprehensive newsletter. And again, just 66 cents a day. So yeah, pretty excited about this.
Yeah, so that newsletter
Oh,
is pulling data from a bunch of free APIs. And what I need to do to really make it like legit is I need to replace some of the paid APIs with you know, different APIs, especially for some of that derivatives data. But yeah, no, it's coming together really well.
no, that's nice. So, I mean, yeah, if you want to go check it out and, you know, and do the no cost sample, then, you know, by all means, you know, check it out. You know, give us some input. You know, send us a message. Let us know, because we want to make sure that it's a great product for you all. You know, most first and foremost. So, well, should we jump right into it?
Let's jump in.
All right, let's go into the Nizoos. All right. So it looks like Bitcoin is just kind of trending right now. Ethereum's trending. Looks like crude oil spiked a bit following reports on extended U.S. naval blockades. So the big news today is the Fed's swan song, Powell's final FOMC. Federal Reserve Chair Jerome Powell begins his final policy meeting today. Markets overwhelmingly expect rates to hold at 3.5 to 3.75%. The conflict, the energy shock from the Iran blockade, is complicating the soft landing narrative. The successor factor, speculation is mounting over a more crypto-friendly successor, potentially Kevin Warsh, which has kept a floor under risk assets like BTC despite the geopolitical tension. So, what are you seeing when it comes to you know, the kind of the exit of Powell and, you know, the potential, you know, Kevin Warsh being the replacement? I mean, do you see this really affecting, you know, crypto or the, you know, the markets overall, or you kind of see this as a nothing burger?
No, I think it's really important because, you know, digital asset markets are, you know, interest rate sensitive. And so if we want to just take a look real quick at Fed Watch, I think that could be valuable, seeing as how today is a Fed day. It's the next meeting is in 1 hour. So in 1 hour and 44 minutes, we're going to have that next FOMC meeting. And then, you know, the really important part isn't necessarily the rate decision, because that's kind of a foregone conclusion. Rates are going to be held steady at 350 to 375 basis points. That's the federal funds rate. So rates are going to be held steady. You could refer to this as a hawkish pause. And, you know, Fed Chair Powell is, you know, he's exiting. And so he's going to be replaced with Kevin Warsh. And don't know a whole lot about Kevin Warsh, except that, you know, we could learn a little bit about him right now. He's, you know, look, on He's going to take the helm on May 16th, and he could be considered kind of like the young gun of the Fed because he's the youngest governor. He was the youngest governor ever in 2006 at age 35. He became the youngest person ever appointed to the Federal Reserve Board of Governors. He was appointed under President George W. Bush. He was a key player. I'm talking about Kevin Warsh here. He was a key player during the 2008 financial crisis. He acted as the Fed's primary liaison to Wall Street. He actually resigned from the Fed in 2011, partially in protest of quantitative easing. And then he spent several years as a fellow at the Hoover Institution and as a lecturer at Stanford. He's married to Jane Lauder, and she's the heiress to the Estee Lauder empire. So that's the, I guess,
Estee Lauder.
Estee Lauder. Yeah.
I think it's like a makeup company, like a women's makeup company.
Right. Yeah. So he's, a lot of people refer to him as a pragmatic.
Estee Lauder.
Estee Lauder.
It was like trying to like.
Yeah. So, people call him a pragmatic hawk. So on inflation, he seems to be skeptical of these traditional wage growth models. And Warsh has been arguing that inflation is driven more by money supply and government spending, which, come on, that's obvious. It's obvious that inflation is driven by money supply and all of this deficit spending. On interest rates, he has historically been a hawk, favoring higher rates, but he's recently turned a little bit more dovish, arguing that AI-driven productivity allows the economy to grow faster without triggering inflation, justifying lower rates. And as far as the balance sheet goes, he's been a longtime critic of the Fed's bloated balance sheet, and he's expected to push for a faster reduction of the Fed's bond holdings. That's quantitative tightening. So this is kind of interesting that he's got a background as a bit of a hawk here. And on regulation, he generally.
So do you think that hawkish posture is going to help risk on assets like crypto? Or
well, it remains to be seen exactly how he acts as Fed chair. But no, a hawkish posture would likely not be bullish for digital assets or anything really. So yeah, it's going to be interesting to see how he acts as Fed chair. But the thing that's going to be important today is the way that Fed Chair Powell sounds. Although I don't know that it really matters because we know that he's hitting the door. So, he's on his way out today. So don't know that it's really going to matter what he says, unless he comes out and says something horrible and markets dump as a result. But, as of right now, just kind of moving sideways. A little bit of a pullback out of BTC and ETH off of a level of resistance last night, but not much for equities so far. If I'm just taking a look real quick at a handful of those large caps, a lot of those are reporting today. So we've got a bunch of really important big tech companies reporting earnings today. So we've got a flurry of data. We're going to get Fed Chair Powell. We're going to get his presser. That's usually market moving. And then after the close, it looks like we're going to get earnings from, let's see here. I think today we get Google after the close, pretty sure. Wednesday today after the close, we're going to get Google reporting. And then let's see here. I think Microsoft too. So Microsoft today after the close. And Apple is tomorrow. And then Amazon. Amazon is also today after the close. And Meta. So we've got Google.
A lot of earnings reports.
Yeah. The most important companies are reporting today too. Google, Amazon, Meta, Microsoft. It's going to be a big, big day of earnings after the close. So
you got the FOMC and a bunch of earnings reports. So there could be some volatility later on today.
Volatility. There's
volatility for the liquidity.
There's definitely going to be some volatility today, no doubt about it. And look, markets have ripped like straight up into a level of long-term resistance, into all of these earnings reports and the FOMC today. So, what do you think? Do you want to be the contrarian, as markets have ripped? What do you
Are
think?
you gonna short the market? Or are you gonna? Or do you think that it's gonna go higher and break through that that resistance and potentially flip support? That's actually a great question. I mean, really quick. I mean, can you summarize? I mean, because we'll get into some charts and stuff here in a bit, but just can you summarize what your thoughts are, David?
I want to be the contrarian. So,
Right.
with Fed Chair Powell, hitting the door and exiting as the chair of the Federal Reserve, and now we're getting someone who seems as though he's got a little bit more of a hawkish posture, entering as Fed Chair in Kevin Warsh, and then we've got all of these big tech companies reporting earnings. The big four: Google, Amazon, Meta, and Microsoft. Those big four, those are trillion-dollar companies reporting today. And they're all reporting after they've ripped higher by, all of them greater than 20 or 25%. So, really, really big moves to the upside. Ask yourself, do you want to be a buyer of these big tech companies after they've already ripped off of the lows earlier this month? Into earnings. I'm not quite sure that I would want to be a buyer of these companies into earnings, seeing as how, hey, you know what? It looks like a lot of that, EPS expansion is a result of the AI data center spend. So
Mhm.
it's going to be really important how they sound in those earnings reports around the AI capex.
All
So
right. All right. So what do we got? All right. So Ethereum versus Solana, the fee divergence. New data shows Ethereum's economic moat is widening. In the last 24 hours, Ethereum generated 2.7 million in fees compared to Solana's 70K, a 40x gap. Activity versus price. Ethereum's active addresses reached record highs, near 600,000 this week, showing a bullish divergence where usage is growing despite sideways price action. So, do you have any data that you could pull up and show the audience that might be able to give some more insight into this? Because this is something this is kind of the tip of the iceberg that David and I talk about on a regular basis, where the fees or the revenue that these projects generate and the correlation or the relationship that that has to us, the token holders. Is there tokenomics or a mechanism in place where those fees or revenue are shared with us in some way? Because otherwise, why the hell would you hold the token? A lot of the the Dino coins, a lot of the legacy coins, they have this issue. XRP is one of them. I do believe Cardano would fall under that. And not to say they're bad projects. The tech is great, but the issue is that there is no direct correlation between the success or profitability of the company and the token holders. So it's a very important aspect to understand in investing is how you benefit from the success or the failure of the company. Or if the price of the token that you hold is pure speculation that is driven by nothing but hype and social media posts. So anyway, David, I'm sorry.
yeah, no, I mean, so Mike, one thing that you can do is just take a look at the token price. Solana looks like crap, man. So, if we're just taking a look at the metrics, a couple of metrics on the weekly. So over the last 7 days, you're right. Ethereum generated $2.7 million in fees just over the last 24 hours, while Solana only 70K. And now, what is the driver of those transactions and fees on Solana? Well, it
Meme
looks as
coins have historically been a huge part, and I've said this for months and months and months. Back when meme coins were, off the hook, the Trump coin and all that. Is I was telling people that the majority of the transactions on Solana are meme coins because Pump.Fun and Pump.Fun was going crazy, and I was like, if this trend drops off a cliff, you're going to see a much different picture for Solana. But sorry, go ahead.
Yeah. So check this out. This is the chart of Solana. And, I can't help but kind of crack a joke here, like SOL, shit out of luck. Well,
Yeah.
if you're holding Sol for the next couple of months, you might be SOL. This is a very bearish pattern. What I've drawn on here, this is a head and shoulders pattern.
Mm.
And these patterns, we're seeing this pattern confirm. So the breakdown below this horizontal at $96 for SOL, that is a confirmation of the breakdown of this head and shoulders pattern. And in addition to the head and shoulders pattern, we've got this bear flag. This is a beautiful bear flag pattern and starting to roll over again after being unable to get even back up to that horizontal level of resistance. Now, another moving average that we could throw on the chart is the 200-day moving average. Solana last bear cycle was able to get up to its 200-day moving average during a bear market rally. But this bear market for Solana, it's been unable so far to get even close to that 200-day moving average. That's a sign of weakness. That's a sign of underlying weakness. So, you got to tell yourself, I want to hold the best and sell the rest. And if you know that Solana is generating a ton of transactions on a lot of daily active addresses, but the primary driver of that transaction volume is meme coins and AI agents, well, that's not valuable transaction volume. That is very low value transaction volume. And you can see that in the fees that are generated on the Solana chain. If we're saying that, just over the last 24 hours, Ethereum generated $2.7 million in fees, whereas Solana generated only 70K. Well, that's a big divergence. That's a 40x difference. Big divergence. And so, what's the driver of fees on the Ethereum layer one? Well, it's high value DeFi and institutions. What's the driver of fees on Solana?
Meme coins.
Meme coins. Okay, so
And to be fair, I mean, there is DeFi on on Solana, but just not at the scale that it is on ETH.
right, so here's the bottom line for me. Users view Ethereum as the safer, more decentralized harbor for large scale capital, which is why it can command $2.7 million in daily fees, despite having a fraction of the transaction count of Solana. So, yeah, I don't view Solana as an institutional DeFi chain. I don't view Solana as a decentralized chain. I don't view the SOL token as any type of store of value either. And it just makes me, it reminds me of the operating system wars and the browser wars, where it was a winner take most outcome. And you got to ask yourself, is Solana going to be able to compete with, Ethereum? And if there's eventually covenants and DeFi on Bitcoin, will Solana be able to compete with Ethereum and potentially DeFi on Bitcoin? Um, I think the answer is maybe, because this technology, Mike, is still so nascent. It's new. It's new technology that there could be some type of upgrade that comes into the Solana chain that really pushes it to that next level, and all of a sudden it's got 1 million transactions per second with that Fire Dancer upgrade. So maybe all of a sudden Solana is able to process a ton of transaction volume, and maybe it gets used for something by Visa or something along those lines. But you still have to ask yourself, does that justify holding the token? Because if there are all of these small transactions that don't generate much revenue for the chain, then does that mean number go up for the coin, for the SOL coin?
It
Um,
can. I mean, if you're staking it, you can earn a little bit. I think it's like 3 or 4%, and then there is a burn mechanism. So I guess the buyback and burn, like 50% of the base transaction fees, and this is just what I'm reading. Please, correct me if I'm wrong, but it looks like 50% of the base transaction fees are burned and permanently removed from circulation. And so that acts as a deflationary offset to annual inflation. If the activity is high enough. So if the activity is going down, like the data is showing, where it only made 60, 70K, potentially, or it could get to a point to where it's inflationary, not deflationary.
Yeah, so I mean, you gotta also say, well, a lot of people say that Solana is killing Ethereum in terms of transaction volume and total transactions. But the data, Mike, I think it does suggest that these chains, they're not even playing the same game anymore.
Yeah,
One is a high-speed engine for microtransactions, and the other is a high security vault for global finance.
yeah,
Big, big difference. And what happens if one of the Ethereum layer twos, or maybe there's some big upgrade to the Ethereum layer one, and suddenly it's able to process significantly more transactions? Well, you could see Ethereum eat Solana's lunch. And you could see a lot of those high speed microtransactions come to an Ethereum layer two, maybe like the base chain. So, and with Plasma One, the Plasma One neobank launching next month in June. So it's almost May. We got a couple days until the start of May. In June, that Plasma One neobank is launching, and that's going to be a hub for microtransactions because that Plasma chain is very, very cheap and very, very fast. So it's going to be really interesting to see whether one of the Ethereum layer twos starts to take over in terms of the microtransaction volume. And now I see in the chat, David Arnold is saying that Sol has 6.5 to 7% staking.
well, he says used to have.
Yeah. So here's the thing. What is the inflation rate of Solana? What's
That's
the
an
inflation
important
rate?
question, because that's, I mean, and it's not just Solana. I like, as always, we're going to point out, the good and the bad for all projects. Canton, it is, my second largest holding. It is inflationary right now, because it's newer. The network usage. This is the same thing that we're talking about with Sol. The network usage isn't to the point to where it flips deflationary. So it's not just Sol that has this issue. There's other projects out there that have this issue. So don't feel like that we're just picking on Sol, by any stretch.
No, 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 not at all. When I take a look at Solana's inflation rate right now, it looks like it's sitting hovering around 5.1%.
Ooh,
Um, yeah, so
so
Solana was
basically staking isn't even keeping up with inflation.
barely, barely. So the current Solana inflation rate is 5.1%, and the current staking yield is between 6.2 and 6.8%. So that means that if you stake your soul, you're going to make a return of a whopping
1%.
1 point something percent.
Yeah,
You know,
yeah.
and ask yourself, does that make any sense
No.
given the volatility of Sol? If you've got to hold an asset that's got like, what is it, 70% vol, something along those lines?
Unless
Yeah.
you believe that this is a bear market bottom, or if you buy, if it goes lower and you buy at a lower level, to where you're buying the bottom. And Sol, I don't think Sol's going anywhere anytime soon. I mean, in my opinion, there's too much going on with it. It's getting integrated into a lot of different things. But if you think that there's a lot of upside coming, and you're gonna hold it, and you're bullish on Sol, potentially, if you're buying it and you're staking it, and at least outpacing the inflation, whenever that pump comes and you start taking your profits, it could work in your favor.
Yeah. So here's the thing,
I
Mike,
see
you
faster
just,
horses personally.
well, I mean, you just said whenever that pump comes, but I can see a future where the pump doesn't come.
Yeah.
And how could the pump not come? Well, what happens if you know
How could the pump not come?
there's no pumping?
We're just gonna keep moving. Keep
There will be
going.
no pumping.
keep
No,
keep keep moving.
no pumping for Soul, man. Look, this is a bear flag. This is a bearish price action pattern. And if we zoom in to this just a little bit, and look, I'm looking at this on the daily. If we zoom into this and I use that low from the beginning of February as my anchor point, and then drag a trend line up to the next higher low and extend to the right,
Hmm.
and we just go like so. Well, now we've got a level of support, and where are we currently trading? Solana is currently trading at that level of support and looking like it wants to push a little bit lower. So,
So,
breaking.
oh, okay. You're saying it looks like it might want to go lower. Okay, never mind.
Yeah, well, I mean, look, if this does push below trend line support, then your next level of support comes in at $77. If that doesn't hold, then we're going back to the lows at 67. So this is like near must hold territory for shit out of luck token, SOL.
Well, and I know there's a level in the 30s because I know last bear market I bought some, not a lot, but I bought some after the FTX collapse. So and made a little bit of money off of it. So yeah, I mean that's a level it could go down to. It's back down into the 30s. You can see way back, yeah, right back in there.
So, yeah, if we just go ahead and zoom out a little ways here and we just take a look at where Solana could go if it were to break down below, where it's currently trading and move down below $67. I've got this level of support drawn in on Solana coming in at, let's call it $32. If
Yep.
we just zoom into the last bear market, um, this high during the start of the bull, this high I marked as resistance. Now, when Solana eventually broke out above that level of resistance, it flipped and became support. So that is a long term level of horizontal support for Solana. Now, a lot of people are going to say that maybe there's some support in here, or there's some support in here, or maybe here. I mean, look, there are clusters of there's trading activity here.
As you can see, yeah, yeah, and yeah.
Yeah. I mean, look, there is some trading activity here, here, and here, but there really isn't a clear level of support at any of those three clusters of trading activity.
No, so I mean, potentially it could be an express train down to that 32 level.
Yeah, I'm coining the phrase altmageddon. That's I'm going to coin that phrase here. You heard it first, Mike. You heard it
Oh,
first.
you've been using that term for weeks now.
Yeah, I'm looking for altmageddon, man, because most of these altcoins, Solana included, are, I think, massively overvalued for the value that they actually provide to users right now, especially something like Solana. Look, if this is the meme coin chain and not the institutional DeFi chain, then I mean, meme coins are not providing value for users. It's just a mechanism to gamble.
And
And
that's literally all it is they are gambling tokens. It's just you're betting on if they're going to get enough mind share that you got in before the majority of the people. And as people pour in because they heard about it on a social media post and promises that it's going to the moon, they FOMO in, it pumps the price, and hopefully you take profits and you make money. And for every person that made $1 million or more, or got rich off of a meme coin, there's hundreds, if not thousands or tens of thousands of people that lost everything. Do you really? I mean, you have to ask yourself, if you're seeing stuff on social media, you're too late. There's people that are getting into these tokens, like they're using bots, to like literally snipe as soon as the token hits the market. So before the chart even appears, before the first candle even appears, they've bought in. Those are the people that are getting rich on these things, not the person that saw it on social media and they're buying it after it's already pumped. That's
so,
your exit liquidity if you're buying it after you saw social media posts.
so Mike, the meme coin that I missed last cycle, I literally missed it by a couple of hours. Okay, was Book of Meme. So this is the Binance data, and
Oh,
this goes
yeah.
back to March of 2024. Now, I don't remember if it launched in March of 2024. I think that this could be missing quite a lot of data here. But I was writing a report in 2024.
I remember you
where
telling me about this.
I highlighted Book of Meme to a bunch of people in a community that I built a few years ago. And so I was highlighting Book of Meme in the Friday weekly report. And I
Mhm.
was saying to everyone in the report, hey, throw $300 into this thing and see what happens. And I didn't take my own advice, dude. So it was, if I had purchased $300 of Book of Meme that
Mhm.
Thursday evening before I published the report on Friday,
Yeah.
the next day, that $300 would have been worth 2 million. $2 million.
Yeah.
300 to 2 million. And dude, I missed that one.
Yeah.
But so yeah, these meme coins, see, that's what draws everyone in, is, the going from a couple $100 to seven figures type, gambling outcome.
Mhm.
And so that's what draws everyone into these meme coins, because they see stuff on social media where people are talking about, hey, look, I did 1,000x, or I
Yeah.
did 5,000x, or something, some crazy outcome like that. But what people fail to understand is that, yeah, if you're going to make a bet where you've got a potential 1,000x outcome within a period of a couple of hours or a couple of days, the most likely outcome there is that you go to zero. So
Well,
it's
and
a
there's something else
lottery
to keep
ticket.
in mind, and this is a great segue to the next topic, is they might be lying.
Right.
It's super easy to, edit a screenshot. If they're just looking to farm engagement, they're looking to build an online profile and make money off of it. They can, basically, take a screenshot of their wallet or take a screenshot and, edit it up so it looks like they made millions of dollars when they didn't make anything. And
Yeah.
so you need to be careful with that stuff because, it's, you can't trust it. You can't trust everything you see on the internet.
No, no, you
So
can't.
yeah. So it says like, and that's our next topic: social media and the on-chain pulse. The FTC, a trending report reveals social media scams led to over $2.1 billion in losses last year, with Meta platforms, Facebook, WhatsApp, being the primary vectors for crypto-related pig butchering and vibe-coded AI scams. So I actually was watching one video yesterday where the dude used an app that basically looks like a legit live stream, where supposedly he had like 60,000 people watching live, and he was out at the club and acting like that he was live streaming. He was a famous streamer, and it hooked up with this hot girl that of course she latched on to him because she thought he was rich and famous because he had 60,000 followers, and ended up hooking up with her. Went to a club, got into the club that had an exclusive club that had a huge line of people waiting to get in. He showed it to the bouncer. It was like, "Hey, I'm live with 60,000 people and want to show your club off." And so the manager came out and like escorted him to VIP and comped him a bunch of stuff, and because of a fake live streaming app. So, you can't believe everything that you see. So, what exactly is a pig butchering scam, David? I've heard the term before, but what is it?
Man, that's a great question. What the hell is a pig butchering scam?
I know
Uh,
that they come out of China a lot.
I don't know. That's a great question, Mike. Let me find out for us right now. So it turns out that a pig
Well,
butchering
really,
scam.
really quick while you look that up, in the chat, give us something to do for a deep dive on the second
Oh,
half of the show.
Mike, I've already got it on lock.
Oh,
It's
okay.
yeah, but I've got some good stuff for us. We're
All
going
right.
to take a look
Perfect.
at these
All right.
these modular lending markets,
Okay.
and we're going to take a look at a protocol, Contango. So we're going to look at three. We're going to look at Contango, we're going to look at Euler, and we're going to look at Morpho. So we're going to run a deep dive on those three, and
Love it.
they're interrelated. So we really need to know how to use them together. But
Absolutely. Absolutely.
so
So pig
check this.
butchering.
Pig butchering, dude, what a name. So pig butchering is a long con fraud that combines psychological manipulation with fake cryptocurrency trading. And the name is derived from the Chinese phrase Shah Japan,
All right.
which which refers to the practice of fattening up a victim with affection and trust before butchering them for their money. The,
Okay, I've
oh,
seen these where they get, they pretend like to be like a hot chick or something like that, and basically work somebody up and then suck them dry.
I mean, look, for any man out there, okay, if you're getting DMs from a hot chick and
It's
you're
fake.
not a multimillionaire and you're not famous, it's
It's
not
fake.
real. It's not real. Okay.
It's
So
fake.
if you're getting some hot chick in your DMs and you're not like, a multimillionaire CEO of some business or famous, then it ain't real. And like, dude, don't give your money to some random stranger on the internet. Like, it's almost always like Pakistani or Chinese scammers, man. Come on. Like that hot chick that you think you're talking
Dude,
to, that's actually a dude named Muhammad. Okay.
random everyday women get hit on multiple times a day. They're not going to be pursuing you, on the internet. It's
Like,
just not going to happen.
it's just like, bro, like, come on, man. 7.2 billion dollars in fraud just last year from
Yeah,
this one type of scam.
yeah.
Just unbelievable. So why don't we just learn a little bit about how this scam works so that no one falls victim to it in our community anyway.
It's
So
it's real easy. Just begin. Whoever you're talking to is is not real. I mean, I've seen plenty of videos out there where there's that new AI where guys have OnlyFans, where they're hot young girls and they're dudes, and however they move, the hot AI girl moves, and it's realistic as hell looking. And yeah, it's they basically have OnlyFans making hundreds of thousands of dollars a month, and you're watching a dude. You're giving your money to a dude.
so this is a really look, you I don't want to make fun of anyone who's fallen for this,
It's an
but
Indian guy making his dinner with his feet.
oh, oh, that's so disgusting, dude. Have you seen that guy, Small Brained American, on YouTube, Mike?
I
He
haven't.
he travels the world, and dude, you got to check out his content. It's really really good. But back to the pig butchering. Okay, so unlike a typical Nigerian prince email that asks for money immediately, pig butchering is a slow con. It's a long con, and it can last weeks or months. Oh man, this is just so awful. So here's the hook. It's the wrong number hook. It says it usually starts with a random text or a WhatsApp message or maybe a LinkedIn request. By the way, who actually uses LinkedIn for anything? I like, so it goes something like this. You'll get a message and it'll say, "Hey, is this David?" And it'll be from some hot chick. And it'll
Yeah.
say, "We met at the golf club. But what if I don't play golf?" or something like that. And so
Oh,
what if
dude, 9 times out of 10, it's probably it's going to be somebody that's like, yeah, you didn't. But all it takes is that one where it's like, oh yeah, no, I do golf.
So even if you say, "Hey, you know what? You got the wrong number," that scammer will try to strike up a friendly conversation. And
Oh yeah.
so that leads into the fattening part, which in Chinese, what was the name of that? Shajapan.
Charge and fine.
Shajapan. So
Charge and fine.
that's the fattening part. That's the trust building part,
Yeah.
where the scammer who uses AI generated photos and deepfakes, they build a deep bond with you. They pretend to be a romantic interest or a successful mentor, and they never ask for money at first. They just talk about their lavish lifestyle, funded by a special crypto trading strategy. Look, if someone is a successful trader, then they're not going to be in your DMs trying to give away their special crypto trading strategy. Okay, that's not real. That's not a thing. And so that's the second step. That's the fattening. That's the Shahjapan. And then here's the next thing. This is the small taste. They suggest that you try a safe investment, and they guide you to a professional looking app or a website, which is controlled by them, of course. You invest real money, maybe $500, and see it grow, quote unquote, to 800. And
Dude,
they even,
Ellie
yeah,
says she even gets the messages.
really.
So she's getting hit on by chicks. Like they're trying to pig butcher Ellie.
Oh wow, man, these scammers, dude, they're everywhere. So yeah, and then they'll give you a small taste, right? Where you invest 500 bucks, you see it quote unquote grow to 800. They might even let you withdraw it to prove that it's real. And then once you're convinced that it works, people invest their life savings, often hundreds of thousands of dollars. And then when you try to withdraw, that's it. The trap snaps shut. And so the platform, this is the final squeeze, will claim that your account is frozen for taxes or anti money laundering or something along those lines. And then they'll demand that you send them even more money, for example, $20,000 to unlock your millions. And then once you stop paying, the scammer vanishes. So, yeah, it's the combination of the AI deepfakes plus the group chat ambush plus the recovery scam. So these things together really, have, it seems as though if there's $7.2 billion in this fraud just last year, then there's a lot of people who have fallen for this. And I'd be willing to bet most of them are elderly or older anyway, because that older generation, they tend to trust more on the internet. For me, when I see something on the internet, my instant reaction is that's bullshit. That's my instant reaction. Like, okay, my instant reaction is verify, don't trust. That's my instant reaction. So I believe all of zero of what I see on the internet until I'm able to verify it multiple times. And Mike, that's why our newsletter is so cool, man, because it verifies every piece of information 3 times across at least 3 different sources. That's the minimum. Three
Yeah.
different sources is the minimum. So yeah, but that scam, man, that's really, really horrible. And the fact that it's mostly being facilitated through Meta products, that makes a ton of sense to me because Meta is the platform for older people. Old people are on Facebook. Um, like it's just a fact. And, they're easier to con because that boomer generation or Gen X is a little bit more trusting of people on the internet. I'm a millennial. I don't trust anything on the internet. Nothing. I
Well, just
verify.
older people just don't understand the technology and how and because a lot of these scammers, I mean, they'll get a lot of information. Like they'll know their email, they'll know their phone number, they'll know their address, things like that. And so they're like, oh, this must be legit. They know this stuff. They don't realize that, with a couple of bucks and an online search, I can find out, past addresses where people live, different phone numbers they've had, emails they use. You can find out all kinds of stuff from people's social media. You can know the names of their kids and their grandkids. It's not hard. I mean, and I'm not super techie. And I mean, I can, figure out a bunch of stuff about somebody. You just need a
So
couple of key pieces of information.
here's the thing, with all of the information that is out there about most Westerners on these social media platforms,
Mhm.
combine that with the dark web, where you can basically buy, enough information to dox just about anyone. I'm talking addresses, social security numbers, et cetera, et cetera. Um, so if you combine all of the publicly available information with, non-public information that you would have to illegally purchase, you can essentially build a dossier on just about anyone. And then you can suddenly come across as, knowing a lot about them when really all you're doing is trying to perform a long con. And old people fall for that, man. So like, when I started DeFi University, Mike, within the first couple of weeks, I started getting targeted scams against me, targeted crypto scams against me to my cell phone, to my email addresses. And
Dude, I get 2 or 3 calls a day for my tax issue, and it's always from different phone numbers, different states. I've ignored them for like a year and a half. They just keep calling. I
I would say that the majority of the phone calls that I get on my cell phone are scams.
Yeah.
And that's kind of crazy, man. The majority
Basically, if
of
it
the
doesn't
calls.
pop up with a name, I just don't answer it. If
I
it's
don't
not
answer.
somebody that I have stored in my phone, I just don't answer the phone.
And here's another thing, the email phishing. So whenever, and this is just something that we need to make like a security best practice just in general,
Yeah.
whenever you get an email from any company
Mhm.
saying anything, doesn't matter what they're saying, never click a link in
I
that email
I
ever.
learned that long ago in the military. It's just you do not click hyperlinks. You don't click anything. It's yeah. It's just you don't download any if there's an attachment. You don't download the attachment. You click on nothing if you're not 100% sure about the sender.
So did you hear about that Robinhood email phishing scam, Mike, that happened recently?
I heard some rumblings about it.
So, look, there's a part of me, as much as I hate the scamming and the theft and the fraud, and I hate that shit. Also, I find myself like sometimes in awe of just how brilliant some of these hackers can be sometimes. And, the Robinhood phishing scam is an example of a technically perfect scam. So the hackers managed to, and this was on Sunday, this was this past Sunday, April 26th. The hackers managed to trick Robinhood's own systems into sending malicious emails to users. And it wasn't your average fake email scam, it was the perfect phishing hack. Most scams use fake email addresses where,
Oh no,
you
they
know,
it sounded like they were using internal ones.
yeah, they were actually. So this is how they did it because
So
it came
so that would
from,
be like me getting one from David saying, "Hey, Mike, I need you to check this out." Click on it, and I
right.
click on it.
So you never, ever, ever click any links in any email ever. If there's a link in an email to go back to Coinbase and log in, what you do instead is you navigate directly yourself in your browser to Coinbase and you log in through a known good link. You have to do it yourself. You don't click on the link in the email. But yeah, man, what these hackers were able to do is they were able to exploit a vulnerability in the account creation process. So when someone starts a new account, Robinhood automatically sends a new login or account confirmation email. And the hackers realized that they could inject their own code into the name or device fields during signup. And so Robinhood's system pulled that malicious code and rendered it inside the official email template. And
Oh,
so, and so users received a 100% authentic, verified email from Robinhood that included a fake warning about an unrecognized device and review activity now, and that there was a button and a link there, and that led to a credential stealing site. So the bottom line here is no matter how good the email looks, you never, ever, ever click a link in an email. Never.
it's just like when you're in Thailand. No matter how good she looks, do a package check.
You've
Always do
got
a
to.
package check.
Yeah, man, that's dude, that would be freaking horrible.
Which one?
Oh man. Yeah, both.
Don't judge. Don't judge. All right. So I got one last news story before we go get in the deep dives, and it's going to be a great segue because you're going to be talking about Morpho. So this is something that we've kind of talked about. How Morpho survived a $300 million DeFi hack nearly unscathed. People think of Aave and Morpho as competitors, but Morpho only lost $1 million when North Korea drained 300 million from a
North
DeFi.
Korea.
North
North
Korea,
Korea.
the architecture explains why, and we've covered this. After North Korea's Lazarus Group drained nearly 300 million from Kelp DAO's bridge, the contagion spread fast, leaving close to 200 million in bad debt on Aave. Morpho, one of the largest lending protocols in DeFi, ended up with about 1 million in exposure. Paul Frambot, co-founder and CEO of Morpho, explains why the protocol's modular, isolated architecture produced a different outcome. This is something that David has talked about in depth, and so have I. And what it reveals about how DeFi lending is supposed to work. He also addresses the ongoing debate over whether DeFi lenders are fairly compensated for risk. That's the DeFi lenders is me and you. The institutional reaction to the hack and what it means for the sector's timeline, the moral complexity of Arbitrum's decision to freeze stolen funds, and why formal verification may be DeFi's last line of defense in an age of increasingly powerful AI. So basically, this is talking about what me and David have gone over multiple times, is the difference, and it's led to why David withdrew his life savings from Aave like 3 days before all this fallout happened. And luckily, is that their architecture is such that all liquidity is pooled together. And that's what exposed and allowed them to basically steal half of the liquidity on no was it no half of the liquidity got pulled off after the hack. It wasn't half the liquidity got stolen, sorry. But after that liquidity was stolen, it led to basically all the different ETH pools getting frozen and being maxed out as far as the utilization, to where nobody could extract their liquidity. And they're still trying to recover from this. This, it's not over yet. So the difference is Morpho, and actually, you know what? Let's just segue into it, because you're probably going to touch on this when you're doing the deep dive. So why waste time going over it twice? So David, take it away.
Sure. So why don't we take a look here at Aave first, okay, just to see, the extent of the carnage. And if we just go ahead and take a look at the USDC market on the base chain, if you're supplying USDC here on Aave in this pooled architecture, and you're earning a paltry 3.48%, you've got to ask yourself, is earning a US Treasury type yield, is that enough compensation for taking on all of the smart contract and protocol risk of having your USDC on Aave and on a layer 2 on Aave? Is 3.48% worth it? I think the answer is no, it's not. You need to be doing something closer to 15 or 20% to make it worth it. This is not enough compensation to make that risk make sense. And if we scroll down here and we take a look at the frozen or paused assets, there's still $200 million of ETH frozen on just the base chain alone on Aave. So that bad debt, that RS ETH bad debt, has still frozen the ETH markets on the layer 2s. So imagine you had ETH on Aave on the layer 2 earning 2.58%. And now it's just frozen. You can't withdraw. You're stuck. So yeah, no bueno. And if we take a look at the other layer 2s like Arbitrum, so here's Arbitrum. Okay, you're going to earn 4.27% supplying your USDC here on Arbitrum. But a couple of days ago, this market was it wasn't frozen, but it was essentially frozen because utilization was at 100%. But if we scroll down here, the ETH market on this layer 2, Arbitrum, is also frozen. And then if we take a look at one of the larger layer 2s, I think Mantle has a little bit more ETH frozen, maybe not, a little bit less. Still, $100 million in ETH frozen on Mantle. So the layer 2s, still. So the layer 2s, the ETH on the layer 2s is still frozen. And, what's the difference in architecture between Aave and, so-called modular lending platforms like Morpho and like Euler? What's the difference in architecture? Well, these modular platforms use isolated vaults. That's why they're called modular. So if there's bad debt in one of these isolated modular vaults, it is not going to spread. There's no contagion risk for that bad debt to spread to other markets on the protocol. So that's a big difference.
It quarantines the exploit.
Yeah, it does. That's a big difference between Euler and Morpho and Aave, let's say. So, what I want to do here is I want to hop into this slide deck on Morpho. And what I really do need to do here, Mike, and it'll take me just a couple of seconds, is I need to turn on my VPN so that we can take a look at Contango. Because
so we can be free. So we can.
No, it's just so that I can log into Contango, because it won't let me open the site. geo fenced. So I want to be able to show what I like to use Contango for, and I'd actually like to go through the process of finding an opportunity on these money markets, and then maybe we could walk through the steps of how you could enter that position. So here, give me 1 second. If you could take over the screen share for just a second, Mike. I just need to flip all my VPNs so that we can get into Contango. So give me 1 second here.
All right. While he does that, I'll pet my cat. But yeah, no, I mean, and this is why we're here, is we really just want to educate people on the differences between these protocols. If you're going to be involved in DeFi, if you're going to be involved in crypto, it's never going to be 100% safe. There's always going to be risks. I mean, there's risks in traditional finance, but we're very early in this technology, and a lot of these safeguards and stopgap measures haven't been fully developed yet. So we need to be knowledgeable and understand how the architecture and how these the different technology, these different protocols work. We need to understand the relationship between the token and the underlying business, and the product or service that they're offering, the pain point that that they are addressing. It's these are the things that we need to understand. And they're called basically the fundamentals. We need to understand the fundamentals of these assets that we're investing in. Otherwise, I mean, you might as well just put a bunch of logos on the wall, put a blindfold on, and start throwing darts. And whatever you hit, you invest in. Because if you're not going to do your due diligence, if you're not going to make yourself knowledgeable about these different projects and and what it is that they're doing, so that's what we're trying to do here. And why I'm invested in a lot of the things that I'm invested in.
Okay, awesome. So I'm back. Let's take a look. And let's see if we can actually find an interesting opportunity. So, Morpho, we're going to check in on Morpho in a second here. But where I want to begin first actually is over here on Contango. And I've got some interesting content, Mike, ready to rock and roll on Contango. And what I want to share with everyone is how I like to use Contango.xyz, and specifically hopping into the simplified tab and then going to USD rates. This is where I like to begin. I like to use Contango as a screener. And the first thing that I want to do here is make sure that I set some settings properly. So, the minimum amount that I want to invest is maybe, let's say, $5,000. And the reason why I input that here is so that all of these really, really small markets, so that they actually, so I don't see them. Because if the size of the market is too small, meaning there's not enough liquidity for me to be able to enter in any reasonable size, then it's not going to move the needle. Because if we're talking about making 60 or 40 or 20 or 25% on, some type of stablecoin product, well, if I'm investing $2,500 or $1,000 and I'm doing 25%, well, that's not going to move the needle, I think, for most people. So I always set the amount to invest to a minimum of 5,000, but you could definitely change this to your liking, right? So after I set that minimum to invest, I want to make sure that I've got a minimum ROE. And so ROE is effectively your APY on invested funds. That is essentially what your ROE is. And so I always set that to a positive number. And right now I'm just setting it to 5. So 5% is the minimum.
Return on equity? Question mark.
Yes, return on equity. Yeah.
I guessed right.
You did. So check it out. Now I'm taking a look at some of these opportunities, right? We've got DAI. So supplying the first asset that you see before the forward slash, that's your collateral. The second asset that you see after the forward slash, that's your debt. So supplying DAI, borrowing USDT on Aave V3, looks like the max ROE that you could generate there is 60%. Not bad. Okay, and that's on Avalanche. That's on the AVAX C chain here. So that actually looks like an interesting stablecoin loop. That does look pretty interesting. But again, I like to use Contango as a screener. I don't necessarily enter positions directly on Contango anymore. I like to enter them manually myself, but I really do like to use this as a screener. Okay, and then here's another one. This is, yeah, so this is a PT. So the collateral here is a Pendle principal token. And, we were talking about Pendle a little bit yesterday. So if I'm supplying this CUSD PT, number one, I really need to know what in the world is CUSD. I'm pretty sure it's compound USD, and I think it's backed by USDC and USDT. Not 100% positive on that. And the fact that I'm not
by default, that would make it compliant with the Stablecoin Act, because if they're backing it with something that's backed by the US dollar or US dollar equivalent, then by proxy it would be compliant as well.
Maybe. I don't know exactly what the language is in those bills, but maybe it's compliant.
Well, that's the research that I did on, and by all means, everybody do your own research, but PUSD, Plume stablecoin, that's what they did, is they backed, instead of having to hold the dollars and everything themselves, they used USDC to back PUSD, and so they hold USDC to back their PUSD.
Gotcha. Yeah. I mean, that's it's like, you're building a derivative on top of a derivative, which does introduce risk for sure.
Oh, absolutely.
And so if we're taking a look at some of these other opportunities here, you've got something called Sexy DAI, borrowing USDC.E on Aave v3 on Gnosis. So Gnosis is a chain. I think it's mainly used for like institutional multi-sig wallets. But yeah, I would pass on this one. And then when you've got the PTS So why don't we take a look at this? This is on Morpho. See, really what I was looking for is opportunities on Morpho and on Euler. So this looks like it could be interesting. This is an SUSDE PT, but you see, here's the problem, Mike. You see the maturity, maturing 7 May. So that means we've only got a couple of days until this matures. And so that means we're not going to be able to enter this. And it's also on ETH mainnet. And so the fact that it's on ETH mainnet means that your transaction costs to enter and exit are going to be significant. And basically, you have to scale a position appropriately on ETH mainnet. Otherwise, transaction costs are going to eat a lot of your gains. So all that means in terms of size is if you're on ETH mainnet and you're looking at interest rate arbitrage on stables, well, you've got to be running like a $30,000 or $50,000 position size. Otherwise, it just doesn't make sense. Your transaction costs are going to just eat up all of your profits. So as we continue to take a look down through this, here's another CUSD PT, but it's on mainnet. This is still on mainnet. It's on Euler though, so we could take a look at this. Here's another one on Euler on mainnet. Okay, just scrolling down through. Now
real quick, David, I want to address this because this is super important. So Ray is watching. Welcome to the show. Is every stablecoin the same as USD-backed stablecoins, or are there stablecoins use that are falling out of the Clarity usage? So I think what you mean is the not the Clarity Act, but the Stablecoin Act. That
Genius, the Genius,
the Genius. Yeah. So to answer your question, no, all stablecoins are not the same, and we won't get in depth on it. We've done it before. Maybe we'll do it again. But it's important to understand that if there's two buckets that I would put them in. There's compliant and non-compliant. And the compliant ones are ones that are backed 1-to-1. They hold in reserves. US dollars or US dollar equivalent. And then there's everything else. And they might have baskets of assets. They might have nothing. So you really need to understand the stable coin that you are using in DeFi, because there's plenty of stable coins that have gone to zero. So, sorry, go ahead, David.
Yeah. So if I could just see if I could answer, Ray is watching, answer his question real quick. Is every stable coin the same as US dollar-backed stable coins? The answer is absolutely not. There are really only a handful of stables that are backed by treasuries or cash equivalents. USDT being the largest, USDC being the second largest. So that's Tether's product and Circle's product. But many other quote unquote stable coins, especially a lot of the stuff that you see on Pendle. If I could just give you an example, if we hop on over here to Pendle, if I just share the Pendle tab real quick, if we take a look at something like USDAI, this is a great example. So this is they call it a stable coin, right? The USDAI product. And then the SUSDAI product is like the yield bearing or the junior tranche coin. So this is rebasing yield bearing. This one is not yield bearing, and you can see that with the underlying APY here at 0 for the USDAI product. But what this is a token that is minted against a protocol's yield generating strategy, whatever that is. So think of USDAI as a business, right? They're a business. They generate revenue or generate yield through some operational activities that they perform. And they've taken that yield and wrapped it up into 2 tokens and a dual tranche system. And they've taken those 2 tokens and arbitrarily pegged them to 1. And then they call them stable coins when really they are not necessarily backed by treasuries and cash equivalents. Now, I do think that USDAI holds a lot of treasuries to back the USDAI product, but they also made like some massive loan to an AI startup in Australia. So it looks to me like their business model is,
That's
kind
that's
of
not. I would not trust that. Well,
right.
really quick on the stablecoin topic. Jay just tagged us in this post by Base 17 minutes ago. Base is now supported by Visa for stablecoin settlement. Our mission is to make on-chain the standard, and this partnership is a major step towards it. It's time to make stablecoin payments a reality for billions. Cool.
That's awesome. No, that's great. So yeah, but these quote unquote stables, they're like a wrapped strategy token pegged to 1. So if I'm a business owner and I generate yield in some way, and I take that yield and I wrap it up into a token and I peg that token to 1 and I call it a stable coin, just because it's pegged to 1, does that make it a stable coin? I don't think it really does. So there are stable coins that are backed by treasuries and fiat, and then there are stable coins that are just a wrapped representation of a business's strategy, whatever that is. So, I've got some other stuff that I want to take a look at here. Why don't we just run through some of that content on Morpho real quick? And then maybe we can see if we can find an actual opportunity on the Morpho protocol. So let's take a look at this. I want to start things off here with the slide deck. And so here's the slide deck. Why don't we just go ahead and run through this? So Mike, I know that you've been talking a lot recently about Morpho's, alignment with Apollo, or this alliance with Apollo.
Yeah.
Yeah, Apollo Global, where they agreed to purchase up to 9% of the Morpho supply. So this is definitely a positive development when you've got a big name like this, essentially buying up a large portion of the token supply. That's a net positive for sure. Now, the architecture, this is the most important thing. If Aave had this modular architecture, then we likely would not have experienced, all of the, yeah, exactly. So here's the architectural, paradigm shift, right? The Morpho ecosystem, you've got these modular vaults, you've got this separation of concerns. So it decouples the market creation, the risk management, and the rate discovery. So it's not pooled. It's universal agnostic infrastructure for degen yield, right? And for TradFi compliance. That's why Apollo invested so heavily. But the legacy monolithic DeFi, this is basically Aave. This is legacy monolithic DeFi. And it's a bunch of lines of intertwined code and high systemic contagion risk via socialized bad debt. This is exactly what we're seeing play out right now with Aave. high systemic contagion risk via socialized bad debt. So, yeah, and you've got these rigid centralized DAO governance bottlenecks. This is exactly what went wrong with Aave, this legacy monolithic DeFi structure. So, compare that with Morpho and also with Euler, where you got this strict separation of concerns, big difference in architecture. So, Morpho's core stack, you got Morpho Blue and Metamorpho. So, this is just a little bit about the interest rate module, the liquidation LTVs, the oracles, the collateral assets, the loan assets. That's all in the base layer, the layer one, the Morpho Blue. That's the foundation. And so it's only 650 lines. Wow, I didn't realize it was that small. 650 lines of highly optimized immutable solidity code. And it provides for completely permissionless deployment. That is pretty cool, just like Euler. So you've got these ERC 4626 compliant lending vaults built on top of that foundational code. And so this allows for active off-chain management by independent third-party risk curators. So those curators, you could think of them almost like money managers. They are going to manage the risk of a vault and potentially actively manage the risk of a vault.
Well, and
So
that's a key difference, on Morpho is you have professional asset managers that are managing these vaults. So, they understand, but they have experience. They've been doing this forever. They understand how to mitigate risk. They understand compliance. They understand, the regulatory structure. They understand, how to, generate yield for their customers. It's basically I see Morpho being more of a TradFi 2.0. This is the merge of DeFi and TradFi, literally. So sorry, just wanted to inject.
yeah, yeah, so this is public DeFi, but I think that some of these vaults can be made private. Pretty sure that there are private credit facilities that can be created using ERC 4626 on Morpho. I know that it's possible on Euler. I'm pretty sure it's also possible on Morpho. So let's see here. Morpho Midnight fixed rate lending. Oh wow! So this is so cool. So it shifts from algorithmic rates to a pure peer-to-peer price discovery and uses cryptographically express intents on duration, rate, and collateral, and crucial structure unlock for illiquid RWAs and maturity matched institutional treasuries. So imagine you're an institutional, client of Morphos, and you want them to create for you a private ERC 4626 vault, a private credit facility where you can, lend at a fixed rate or borrow at a fixed rate. Think about how valuable that is. You can do a lot of really cool financial engineering with fixed rate lending and fixed rate borrowing. And then they've also introduced these Morpho agents. So this is for autonomous finance. And it looks like it connects directly to 130,000 plus on-chain AI identities. I wonder what that means. What is an on-chain AI identity? So it looks like,
I mean, it's probably just different AI agents.
well, I mean, it says here the builder agent, it says interfaces with agents.md. So it's a markdown file. This looks almost like, some type of OpenClaw or Hermes file
Mhm.
via large language models for instant integration, code generation. So that's kind of interesting, being able to build agents that work for you on the Morpho protocol. Okay,
Well,
so
and with X402, being able to navigate, Web3 and navigate paywalls and execute whatever it is that you task them to do, and not be confined, by those paywalls. So it really is. I mean, a lot of these institutions are going to start building out automations, using these AI agents. And again, it's just I see Base, making all those right moves again. Almost everything we talk about, it seems like that they're kind of ahead of the group when it comes to these advances. So
yeah, yeah, the base chain is definitely making a lot of the right moves. So we really do have to compare that legacy pooled architecture once more with Morpho's efficiency. So, if we're talking about that legacy pooled inefficiency, lenders are going to earn less aggregated yield than borrowers pay. And the spread is captured by the protocols to subsidize unpredictable withdrawals. So, this is what Aave was trying to solve for with V4, with the hub and spoke model. Unfortunately, they weren't able to migrate all of their liquidity over to V4 quickly enough. And also, the engineering team that built V3, they left, and
Yeah,
because they didn't like V4, is what I understood. So,
yeah.
but on Morpho, the peer-to-peer efficiency model, so direct peer-to-peer matching within isolated markets eliminates that spread. So that is pretty good. Okay, market dominance. So are there really 10? I think it's a little bit more than that now. I think it's like $11.7 billion in total deposits on the Morpho protocol now. And look at that, 1.4 million active users. Wow. I remember when one of my clients showed me Morpho for the first time a couple of years ago, and I didn't really like it all that much. But it turns out that 1.4 million active users do. So that's pretty cool. But take a look at the yield differences, the yield superiority versus the monolithic incumbents, and really it's just the one. It's Aave. So you've got Morpho's USDC yield of between 4 and 8%, and then Aave's variable rate yield of between 3 and 6% on average. So ask yourself, is 3 to 6% enough to justify the risk of being exposed to that legacy pooled asset architecture on
Looks like
Aave?
Morpho has less risk, better yield.
Yeah, that's the way I would put it too. So multi-chain topography, you get a big, a lot of assets on the base layer two. Morpho has partnered with some protocols on Hyperliquid. I think that there is isn't Hyperlend? Aren't they partnered with Morpho in some way?
I believe
Um,
so. And this I haven't seen it yet, but Morpho is partnered with Plume. With
right.
Nest Credit. Those vaults over there. So institutional vaults. So yeah, Morpho has a lot of integrations with other chains, with other protocols. I mean, it's really becoming a liquidity hub, you might say. And same thing with the new aerodrome is looking to be where it's going to be a liquidity hub as well for another aspect of DeFi. But continue.
Liquidity.
Liquidity
So
is the key.
speaking of liquidity, so if we're taking a look at different yield,
Sandwich
check
is
this
what
out.
brings us here today.
So, I mean, if we've got the risk curator economy on Morpho, that is a really unique feature that you don't see on any other money market. So, you've got Stakehouse Financial. They're a compliant, for compliant EU stablecoins through Societe Generale. And then you've got Bitwise, ring fenced 6% yield in TradFi vaults. So when they say ring fenced, that makes me think that it's a private ERC 4626 vault on Morpho. And then you've got Unified Labs, tokenized Asia real world assets, probably also in some of those ring fenced or private credit facilities. You've got Gauntlet, enterprise quantitative modeling. These are the risk curators on Morpho. You've got Block Analytica and B Protocol, flagship automated ETH and USDC liquid staking token vaults. You've got RE7 Capital. Now, RE7 Capital, days and days before the RSETH, the Kelp DAO blow up,
They
RE7,
de-risk.
they de-risked, right? So, and they focus on high tail risk optimization for crypto hedge funds. And they saw the writing on the wall and they got out before things got bad. So, yeah,
Do I can't stress it enough. If you see big money doing something, and they're not the only ones. There was a couple of others too. David's one. He got out before he saw the writing on the wall, and and we put it out 2 weeks before it happened. that we had concerns. And that's why David got out. But this is why I'm bullish. I know it goes against the CryptoPunk ethos, but this is why I'm bullish on institutional DeFi. Is they know how to make steady yield. Is it going to be the massive amount of yield that we're used to? I believe that there's still going to be plays like that. If you want to up the risk, if you want to lever up, but if for good steady yield, I'm happy with 10 to 20, 30%. If it's good, solid, steady yield, low risk. If it's higher risk, I want higher yield. But
Yeah. I mean, look, you need to demand to be compensated appropriately for the risk that you're taking. And I think that a lot of users on Aave didn't understand the risk that they were actually taking having assets in that pooled architecture model.
most of them
Um,
probably didn't even know that anything about the architecture. And if you told them, they probably wouldn't. It wouldn't even register that it was a risk.
Yeah, well, institutions definitely understand that risk, and we've seen Aave's TVL crater since that whole, exploit took place. If we take a look at Aave's TVL, am just looking at it real quick, 14.2 billion, down by nearly 45%, and
So
just in the last, yeah,
it's
it's
flipped even more.
yeah, it has. And I mean, look, that reputational damage, I don't see how they're going to be able to recover from that. Especially when you've got competitors like, Morpho and Euler that offer, modular architecture and don't have all of the reputational baggage now that Aave has, especially Morpho. Euler does have some reputational baggage because Euler V1 was exploited for the whole deal. It was like $200 million. That was all of the liquidity on Euler V1, and it was all stolen. Now, they were able to get it all back and make their customers whole, but still something to know. Now, if we're taking a look at this DeFi mullet architecture and these institutional integrations with Morpho, what is the DeFi mullet, right? Well, business in the front, that's the consumer and institutional access. But
Sexy in the
then
front, party in the back.
there you go. So, hey, who are, a part of the businesses? Who are the businesses that are integrating with Morpho? Well, it's Coinbase for retail crypto-backed loans. They've got almost $1 billion in originations and a zero-click user experience. So that's the traditional Web 2 stuff that you're used to in the front, but the DeFi money markets, the Web 3 stuff in the back. So Anchorage Digital for sovereign custody and idle balance sheet yield for institutions. And then you've got Taurus Protect. This is FINMA, regulated access for 40 plus EU commercial banks. So, and then here's the party in the back. This is all routed through the Circle CCTP unified liquidity routing, right? All liquidity invisibly routes to hyper efficient Morpho Blue smart contracts without the end user interacting with Web3 interfaces. That is the DeFi mullet. Okay, and then you've got the tokenomics of the Morpho token itself, and that might actually be worthwhile to take a look at just real quick. What do you think, Mike? You want to just
I'm
hop
actually
in?
interested to see that too, because it's been a somewhat of a concern of mine of that disconnect between the profitability of the protocol and how we benefit as the token holders, because there's not a whole lot of things to do with the Morpho token.
Well, except hold it.
Yeah,
And yeah, so
but is there something in the tokenomics or mechanics that makes it deflationary, or through buybacks and burns, or is there something that we the token holders share in the profitability and success of Morpho the protocol?
well, you really need to think about that because I think that the answer is yes. I think that the
Okay.
answer is yes, but I'm not 100% positive on that. So we would need to do a deep dive specifically on the tokenomics of the Morpho token.
Mhm.
But what I see is Morpho trading above its 200-day moving average.
Mhm.
That is a really good sign. And it looks like, even though it broke down below it briefly, that it was able to regain that
Don't
200-day moving average.
don't mind that little
So
guy. Don't mind
yeah.
that.
So I mean, no, this is a good thing because most digital assets, Bitcoin included, Bitcoin is trading well below its 200-day moving average here. So, this is the fact that the Morpho token is trading well above its 200-day moving average. That is a net positive. That's a good thing. Now, where's the next level of resistance on the upside? Well, comes in at $2.87. That's the next level of resistance on the upside for the Morpho token. So if this rally were to continue, well, then that's where I would expect there to be, significant resistance on the upside. But what is this pattern that we see playing out right here, and here? This is referred to as a double top. So if I just throw down a trend line like so, you've got the high and then rejection at that high. So this is a level of resistance too. But if this breaks $2.08, if that breaks to the upside, then that Morpho token could rip, by another dollar all the way up to 288 or something like that. So the token doesn't look half bad. In fact, it looks pretty darn good to me. I'm still waiting, Mike, for the video overview to finish on the Morpho protocol. Oh, it did finish. Awesome. So let's take a look. I want to watch this video overview because I think that this could be insightful for us. So let's go ahead and check this out. And Mike, if you could just let me know if the audio doesn't play. Here we go.
It's not playing.
Okay, gotcha. Let me go ahead and restart that screen share so that we can listen to that audio as we watch the video content. I think that this is going to be a good one. Here we go.
Massive influx of institutional capital strictly demands institutional-grade on-chain infrastructure. The global market capitalization for dollar stablecoins has expanded past the $2 trillion threshold. This surge has forced federally chartered digital asset banks to aggressively seek productive, verifiable yield for their clients. The regulatory catalyst for this massive institutional migration is the Genius Act. By establishing a clear legal framework, the legislation prompted massive corporate treasuries to begin routing their balance sheets directly on-chain. The monolithic experimental architectures built during the previous market cycle are structurally incapable of safely housing this new trillion-dollar scale of institutional liquidity. Right now, the global decentralized lending sector operates as a high-stakes $73 billion duopoly between two major platforms. On one side is Aave. It commands over $40 billion in total value locked through an extensive multi-chain footprint serving the broad retail market. On the other side is Morpho. In early 2026, it eclipsed the $10 billion milestone by actively siphoning yield-sensitive institutional capital and corporate treasury allocations. Morpho's expansion relies on a mathematical rejection of shared liquidity pools. The architectural divide between pooled and isolated markets determines how credit scales in an on-chain economy.
So this is super important. This is something that everyone who's listening to this call or watching this call right now, we all need to understand this difference between the pooled architecture that failed on Aave and the isolated modular architecture on Morpho and on Euler. This is a big, big difference. And so we need to understand this.
To understand the difference, we have to look at how early decentralized lending protocols manage capital. This diagram shows a monolithic shared liquidity pool, the architecture used by platforms like Aave version 4. All supplier assets are aggregated directly into a single massive reserve. This structure carries a severe flaw. Because the protocol must accommodate unpredictable retail withdrawals at any moment, a massive percentage of the supplied capital must sit entirely unutilized. It cannot be lent out. This creates what is known as the spread inefficiency. Because so much capital sits idle, the aggregate yield paid to lenders is mathematically forced lower than the aggregate interest paid by borrowers. The protocol captures the difference between these two rates to subsidize the idle capital. Monolithic architectures inherently tax their users, capturing value specifically to offset the inefficiency of their own design. Morpho eliminates this tax entirely by excising pooled mechanics from its base layer. The foundation is Morpho Blue. It is a hyper-efficient, immutable smart contract comprising exactly 650 lines of non-upgradable code. Morpho Blue enables permissionless market creation. Anyone can deploy an entirely isolated lending market by fixing 5 permanent parameters upon deployment, including the collateral asset and the pricing oracle. These strictly isolated markets enable direct peer-to-peer matching. For matched pairs, the spread shrinks effectively to zero, achieving near 100% capital efficiency. This precise structural efficiency is why Morpho stablecoin yields consistently outperform Aave's algorithmic rates. However, managing hundreds of highly isolated markets introduces a complexity burden. Passive capital cannot actively monitor individual market parameters. To solve this, Morpho utilizes Metamorpho, a vault layer sitting directly above Blue. Here, independent professional risk curators use quantitative models to dynamically manage capital allocation across specific markets. By strictly separating market creation from capital curation, Morpho completely externalizes risk management. It relies on specialized, data-driven professionals rather than the centralized mandates of a protocol DAO. In April 2026, the entire decentralized financial system was subjected to a high-stakes cyber attack, providing a real-time stress test for these two architectures. A state-sponsored entity, identified as the Lazarus Group, exploited a bridge configuration. They successfully minted unbacked RSETH tokens across Layer 2 networks. The attackers immediately deposited these fraudulent tokens into Aave as collateral, rapidly borrowing $236 million in highly liquid assets against them. Because Aave relies on a unified liquidity pool, the bad debt generated by the unbacked RSETH was instantly socialized across the entire protocol. The market recognized the contagion immediately. A 72-hour bank run triggered a $15.1 billion outflow, maxing out stablecoin utilization and freezing legitimate user withdrawals.
Okay, so this is why we need to understand the difference between the monolithic pool architecture and the modular isolated markets. That is a part of the risk of operating on a monolithic pool. What happens if there's bad debt? It gets socialized, and then when users go and rush to withdraw or borrow stables because they can't withdraw, then utilization goes to 100%, and all of a sudden, no one can move. The protocol is essentially frozen. So yeah, that's a bad day.
Yeah.
Concurrently, Morpho remained completely unaffected by the exact same toxic asset. The isolated structure mathematically contained the damage to a single column, protecting the deep liquidity of the surrounding vaults. For institutional risk officers, the event demonstrated that counterparty risk becomes nearly impossible to manage when it is socialized across a single, unified pool. Having secured the isolated yield sector, Morpho expanded its parameters to capture traditional fixed income markets. Corporate treasuries and massive asset managers require predictable, fixed-term credit. They structurally reject the algorithmic floating rates utilized by standard decentralized finance. To service this capital, the protocol launched Morpho Midnight. It is an intent-based lending system designed to run concurrently with Morpho Blue. Midnight abandons automated, formula-driven rates entirely. Instead, borrowers and lenders cryptographically express precise intents regarding duration and yield, allowing the protocol to execute definitive, fixed-rate peer-to-peer matching. By externalizing the rate pricing, institutions can completely customize complex loan structures, unlocking the ability to cleanly collateralize illiquid real-world assets. In tandem with this fixed-rate expansion, Morpho launched specialized infrastructure to capture the 130,000 artificial intelligence systems operating on-chain. Morpho Agents strips away human user interface bottlenecks. It provides machine-readable operational surfaces, allowing algorithms to read fault data, simulate complex network transactions, and execute exact rebalancing commands. By servicing fixed-rate mandates and AI-driven flows, Morpho is shifting from a retail application to a structural foundation for credit. The economic engine governing this entire architecture is the Morpho token. Across $10.5 billion in value locked, borrowers generate over $170 million in annualized interest. Yet the protocol captures a 0% take rate. Activating a 10% fee switch instantly generates $27 million in recurring revenue. The government's DAO actively refuses to flip this switch. Activating it would immediately compress user yields, sacrificing the exact capital efficiency advantage that is currently siphoning market share away from Aave. Sophisticated asset managers do not price the Morpho token as a mature, dividend-yielding asset. They price it as premium growth equity, prioritizing absolute market monopolization over immediate cash flow.
Okay, so that last statement, Mike, that was really important. So it's categorized as premium growth equity, the Morpho token, not as a yield bearing asset, not yet anyway. But I'm pretty sure that there's a proposal, that there's a Morpho proposal to flip a fee switch,
Mhm.
and that would allow that premium growth equity to suddenly earn yield. um, so I mean, maybe, dude, maybe the Morpho token is even right now a great deal.
I
It
I
could
bought
it
I mean,
could be.
I got a bag of it, not a huge bag, but I got a bag of it because I'm definitely bullish on Morpho.
I'm bullish on it too.
In February 2026, Apollo Global Management executed a strategic agreement to systematically acquire By removing the spread inefficiency and mathematically isolating risk, the protocol is becoming a primary settlement layer for on-chain lending.
Oh no, what happened? It looked like the last couple of seconds got cut off almost. Is that what happened there? Let me see if we can play this back real quick.
Prioritizing absolute market monopolization over immediate cash flow. In February 2026, Apollo Global Management executed a strategic agreement to systematically acquire by removing the spread inefficiency and mathematically isolating risk.
Okay, well, it looks like the last couple of seconds there of that video content got cut off. But Mike, my key takeaways from that piece of content are, number one, that there's a big difference between isolated architectures or modular architectures and pooled architectures. And the pooled architecture is how we can explain the contagion after the Kelp DAO layer 0 exploit. So it was contagion through the socialized risk on Aave. That was how it spread. Um, so yeah, I mean, and also the Morpho protocol, its token, that Morpho token itself, is actually starting to look like an interesting opportunity for investment. That's the way I'm thinking about it. Something that maybe you hold for the next couple of years. So that's
It's gonna be a gateway token for you. Soon you're gonna be buying Arrow.
not a chance. In fact, now that you bring up Arrow, I put together an interesting piece of content here on VE33. So
Well,
this,
that might be a waste of time because that's about to go away. I mean, the new Arrow platform that's launching in July, it doesn't use that model anymore.
right, because that model sucks.
Yeah, no,
Yeah.
and it looks like they agree, because like I said, they're getting rid of it. So
Okay. Well, good. It was a smart move on their part. So here, I've got something interesting here for the last couple of minutes of today's call. We could take a look at, we just looked at Morpho, right? Well, if we're looking at Morpho, we've also got to be taking a look at Euler, because these are, the two premier modular isolated money markets on Ethereum chains. So why don't we take a look here at Euler, and then I think, Mike, we can wrap it up and call it a day.
all right.
By early 2026,
Oh, whoops. There we go.
By early 2026, the decentralized finance ecosystem was operating under a severe contradiction. Capital was abundant, but the market was paralyzed by the memory of catastrophic smart contract exploits that had drained early lending protocols. The macroeconomic data showed a clear rebound. By April 2026, total DeFi value locked climbed back to $95.07 billion. Yet, despite the influx of capital, the crypto fear and greed index remained in extreme fear territory. Institutions were willing to deploy capital, but they demanded pristine security guarantees. This environment highlighted the core architectural trilemma of decentralized credit. Engineers have constantly battled to balance two opposing forces, maximizing capital efficiency to generate high yields, while simultaneously mitigating the risk of systemic bad debt contagion. The first generation of lending protocols utilized a monolithic model. Systems like Aave v3 aggregate all deposited assets into a single global liquidity pool. By socializing the risk, they achieve broad global liquidity and high rehypothecation. But that socialization is a structural vulnerability. In a monolithic pool, a single oracle manipulation or the listing of a flawed long-tail asset compromises the entire system.
That is exactly what happened to Aave. So not only did they have RSETH listed, but they increased the LTVs and allowed users to turn on mode and borrow a ton of ETH against it. So that was how the hackers, the exploiters, were able to monetize that RSETH that they minted out of thin air through the layer 0 bridge exploit.
Well, and
Um,
put their exploit on steroids. I
yeah,
mean, it's like, already, they would have been able to, get away with a lot of liquidity, but because they raised those LTVs, the loan to value, it made it to where they were able to exploit even more.
yeah.
The losses are socialized across all depositors, regardless of which assets they personally supplied. To solve this, protocols like MorphoBlue moved to a strictly isolated peer-to-peer model. They rely on immutable smart contracts that pair exactly one collateral asset against one borrow asset, creating isolated bilateral markets. The trade-off is immediate. While isolated bilateral pairs eliminate systemic contagion, they fragment liquidity across disjointed markets. This leads to lower capital utilization and a more complex experience for the end user. Euler v2 proposed an alternative to both models, utilizing a cross-collateralized modular infrastructure. It was designed to maintain the security of strict isolation while recovering the efficiency lost to liquidity fragmentation. This chart compares the quantitative outcomes of these three systems in 2026. Aave's pooled risk model yields a 37.72% utilization rate. Morpho's isolated pairs improve this to 66.56%. Euler v2 leads the market at 85.40%. These performance metrics suggest that by April 2026, Euler's approach successfully severed risk instantiation from credit routing. It achieved an 85.4% utilization rate without reverting to a socialized risk pool. We can deconstruct this by looking at the base layer, the Euler Vault Kit, or EVK. The EVK is a smart contract framework used to deploy passive lending pools. Users deposit assets into these independent vaults, receiving ERC 4626 compliant share tokens representing their debt positions. The primary advantage of the EVK is permissionless deployment. Any user or entity can instantly instantiate a lending vault for any verifiable ERC20 asset.
That is extremely powerful because if any user, this is permissionless, if any user can instantiate an ERC 4626 vault, then that means that you can essentially create your own private credit facilities. And if you wire up a couple of different vaults together and then mint tokens against them, dude, you can build some really, really interesting financial products.
Well,
This bypasses
that's one
DAO.
of the things that I'm really liking about what a lot of the leading protocols on base are doing. Like Arrow and Morpho, to where they're allowing dApps, through AI or manually for you to build dApps and access and give services and vaults, being able to give access to the liquidity for different products and services. So it's just, there's a lot of really cool things going on. But yeah, sorry.
Yeah, no, there really are. I mean, when it's permissionless, then anyone can build, and that's the beauty of Euler.
Governance, eliminating the need for lengthy voting processes to list a new token. Because each EVK vault operates as an independent balance sheet, the risk is physically isolated. If an asset within one vault loses its entire value, the silo collapses. But that failure does not drain the liquidity or impact the solvency of the surrounding vaults. This isolation allows creators to dictate exact vault stratification. They can define the specific utility, parameters, and risk profile for their market. including custom interest rate models tailored to the unique liquidity profile of the underlying asset. For instance, highly volatile assets can be placed into specialized non-borrowable vaults. In this configuration, the asset can be used purely as collateral, protecting it from being borrowed and sold short. The EVK successfully quarantines risk and eliminates pooled contagion. However, deployed on its own, it creates a landscape of fragmented, disconnected capital silos that lack the efficiency of a unified market. To resolve that fragmentation, Euler introduced the Ethereum Vault Connector, or EVC. The EVC acts as the overarching routing layer, serving as the connective tissue between the isolated EVK silos. Euler delineates security responsibilities between these two layers. The overarching EVC is solely responsible for authenticating cryptographic signatures, verifying who is initiating the action. Individual EVK vaults retain control over authorization, verifying balances and collateral factors. This separation of logic enables cross-vault composability. Through the EVC, a user can deposit an asset into one independent vault and immediately pledge those deposit shares as collateral to borrow an asset from an entirely different, unrelated vault.
So that is extremely powerful. So you can wire this stuff up in such a way that if you've got a cheap form of leverage, like if you can borrow money on the cheap and then use that as leverage for some collateral asset that's yield bearing or generating some yield, then you can lever that up across your own private vaults. It's so cool.
Unrelated vault. To manage this cross-collateralization, the EVC grants every interacting address 256 internal virtual subaccounts. These subaccounts allow a single Ethereum address to isolate different strategies. A user can run a high-risk leverage trade in subaccount 1 while running a conservative stablecoin loop in subaccount 2. The risk profiles never cross-contaminate. The EVC also utilizes a primitive called deferred checks. In traditional DeFi architecture, the protocol must verify account solvency after every single step of a transaction, creating significant technical friction. The EVC delays these solvency and borrowing cap checks until the absolute conclusion of a transaction batch. This allows users to bundle actions, flash borrowing, swapping, and depositing, into a single atomic block, provided the math reconciles at the end. The EVC's ability to mathematically link these disjointed vaults is what enables the system to achieve its 85.40% utilization rate. It maintains the isolation of the underlying assets while providing the capital flow of a shared pool. The resilience of this modular model faced two massive stress tests during the contagion events of late 2025 and early 2026. The first occurred in November 2025 with the collapse of Stream Finance. Following a $93 million misappropriation, Stream experienced a 77% depeg of its synthetic stablecoin, XUSD. Because XUSD was utilized as collateral, monolithic protocols suffered massive bad debt. The deficit rapidly spread through recursive lending structures across multiple networks. On Euler, lenders who had supplied capital to vaults that did not accept XUSD experienced zero bad debt and no liquidity freezes. The modular structure successfully blocked the contagion from spreading beyond the affected vaults. A second test hit in April 2026. A breach of the Kelp DAO liquid restaking protocol resulted in $292 million in illegitimate RSETH being minted and immediately dumped into lending protocols to borrow hard assets. This illustrates localized damage in a modular system. A single structural failure is physically contained without destroying the pulse of the surrounding network. As the stolen RSETH flooded the market, monolithic protocols hit 100% wrapped Ethereum utilization, requiring emergency global freezes. On Euler, curators simply halted their specific RSETH exposed silos. The rest of the protocol operated without interruption. These events clarified the structural trade-off of modularity.
Okay, so I think we've run out of time here, Mike, but that was a great way to end it. Just comparing the difference between these modular versus monolithic protocols. And
Not all protocols are made the same.
They're not. And we need to know that. Cool, man.
Awesome. All right. Well, if you haven't already, if you could please do what Ellie's been asking in the chat, what I've been asking in the chat. If you enjoyed this content, if you could at a minimum, please just hit the little thumbs up, give us a like. It helps us get this information out to more people. And if you are so inclined and enjoy the content and want to make sure to catch all of our shows, we are again a massive network. We have 7 different channels on this network, and we have three to four shows per day, live shows per day. That everything from crypto to DeFi, to news, interviews, deep dives, airdrops, gaming, you name it. We even got emergency preparedness and homesteading. So there's a little something for everybody here. But follow us, and share out these streams and help us get this information that we give out at no cost. I mean, this is all 100% no cost content. So till next time, we appreciate you, and make sure to join David at 1 p.m. Pacific, 4 p.m. Eastern is our next live show. And tonight, Jay, Ellie, and myself, and potentially David might be gaming tonight. So join us for some laughs and some drinks. And until then, Veteran Crypto out.
Peace.